Hi, welcome to Three-Statement Financial Modeling of Microsoft Stock. By end of this video, we will develop a fully integrated three-statement financial model for Microsoft. That is, we will evaluate or we will forecast what is going to be the income statement for Microsoft going to be for the next 5 years, and what is going to be and how the balance sheet is going to look like for the next 5 years. Then how the cash flow statement is going to look like for the next 5 years. In the cash flow statement, we will go through all the three steps, that is cash from the operation, cash from or cash used in investing activity, and cash used in financing activity. On top of it, if you could note, there are some line items in balance sheet which are marked in a different color. On top of it, the same with the cash flow statement. For each and every line item, that is, for say if it is depreciation and amortization, which is not straightforward to forecast, there we will use a schedule development method. Here I have created a depreciation and amortization schedule. Here I have done a property plant equipment schedule. Here I have a non-current asset schedule, and here I have a long-term debt schedule, and here I have an interest schedule. So likewise, wherever I feel it is most appropriate or it's a best practice to do a schedule rather than just doing some random forecasting, I have developed a schedule as needed. On top of it, one could argue that, you know what, the revenue which you took is less or the revenue which you took is high. So that is where, as per the best practices, what we would do is do a sensitivity analysis. Like here I have picked or cherry picked four line items. For this, I have considered what could be the best case and what could be the weak case. To show you what I mean, say here all these numbers are right now as per the street case, that is a normal case. Say here, from here, if I want to switch, I can switch either to best case and see how the numbers looks like, or I can go to the weak case and see how the numbers would look like. For example, right now in the street case, you could see by 2026, the net income of Microsoft I have forecasted as $114 billion. But if I switch from street case to best case, you could see the number all the way change from 114 to $128 billion. Similarly, if I move from best case to weak case, you could note that not just this number, pretty much everything in the forecasted would change. So that way, this model will be fully integrated. By even changing one input anywhere in this model, this model will ensure that is accommodated or reflected in all the three statements like income statement, cash flow statement, and balance sheet. So on top of it, one might have a simple question: why should I do this? Because this video might be like 2.5 hours to 3 hours long. Why should someone watch this video, or what is the benefit of doing this financial statement model? If you're watching this video, might be you should have known discounted cash flow analysis or DCF valuation model. So while doing the DCF valuation model, we need to calculate the free cash flow, in specific unlevered free cash flow. So to get to the unlevered free cash flow, we might need some inputs like capital expenditure, depreciation, amortization, working capital, and NOPAT. So to get this information, rather than I take the input from some random data source, this model, I prefer the taking data from this model, because I developed, or you could have developed, each and every line item based upon the understanding you have on the business. So that is why I would prefer this financial statement modeling will be a helpful tool. On top of it, someone would also do the comparable analysis or relative valuation. In that case as well, to compare one company with another and see how the company is trading, this model would be helpful. So we will develop all this financial statement modeling in this video, everything starting from a blank Excel sheet, and we will go through what are all the nitty-gritties involved and what are all the best practices, at least to my knowledge, has been followed. Before getting started, a quick disclaimer: this video is just for educational or information purpose only. In any sort of means, this is not going to be a financial advice. So please ensure or please do your own research before you either buy or sell any stock. So with this, let's get started, and we'll start with the income statement modeling. So to start our proceedings, I will just go to Microsoft SEC filings and get the most recent annual report. For that, I'm just going to type in Microsoft SEC filings and just open up the first link, which will take you to the web page where Microsoft have all the annual and quarterly reports. In this, I'm only interested in the most recent annual report, so I'm just filtering it by annual filings and just hit filter, which will give the 10K filings as of July 30, 2025. So this is the form which I'm just interested in, and I'm just opening it. So if you could see, this annual report has been published as of the fiscal year ended June 30, 2025. So this is the most recent report. Let's take this report as our base and try to develop our financial statement model. So with that, let's go back here and start putting the numbers. The most recent end is 6/30, 2025. So with that, uh, I'm thinking, no, what I would do is take 3 years of historical data. Say in this 10K report itself, I'll have 3 years of historical data of income statement, cash flow statement. For balance sheet, I'll just have 2 years, but that's fine. Then try to project the next 5 years historical or next 5 years. So that's how I'll do. So I would do is 2023. Then I'll just put end of month of this value like well. This would give me the rest of numbers. I'll just change it into short data. Okay, so we have 3 years of historicals and 3 more years of, I mean, 3 years of historical, that is these three guys, and then 5 years of projected data. Okay, so with that, first let's go to our income statement in the 10K report. Okay, so here is where we have our income statement. Might be, I hope, if you are reviewing, I mean, if you are up to a point in doing the financial statement modeling, you could have understood the business model and fundamental analysis of Microsoft. Might be, I wouldn't dwell deeper into what has been constituted as what set of revenue are coming under product, what set of revenue are coming under service and others. Might be, if needed, I will put the link to the financials. Sorry, I'll put the link to the fundamental analysis of Microsoft, which I did in this comment section. Please make sure to watch it. But for now, I'm just assuming that we know the background of Microsoft, what business they are doing in, and what each and every line items in the income statement means. With that assumption, let's get started. So first, what I do is I'll just first get all these line items into our Excel, then just type in whatever is the historical numbers for 2025, 2024, and 2023. From there, let's project to the next 5 years of numbers. So with that, let's get started, and I will just mention this as income statement. So I do this in bold. We'll just zoom in a bit if it is sufficient. I hope it should be fine. Let's put it some borders. Okay, so the first line item in the income statement is, maybe, will most of the income statements start with total revenue, but since Microsoft have mentioned as product, service and other as two different segments, I'm also going to use the same two line items as product and service and other. So first product, service and other, then the next one is total revenue. Might be, I will do one thing, just minimize the screen, then type it up. After total revenue, we have cost of revenue, or in sometimes it's referred as cost of goods sold or COGS. So for product and service, product and service and others, Microsoft have reported what is the COGS. So we'll get in that product COGS, service and others COGS, then total COGS. After that, we have gross margin. Gross margin is just difference between the total revenue and total cost of revenue. We'll also have that. Then they have further three line items: research and development, R&D, Second one is sales and marketing, and then general and administrative. Let's get in that. I'll just put R&D, sales and marketing, and then general and administrative. Next one, they have operating income. I'll just type it out. Other income, expenses, net income before income tax, provision for income tax, and then net income. So these are all the line items which we have, out of which I'll just bold some items which I would definitely need in future or the later part of the video. So now since we got this, let's start putting in the numbers which we have. Maybe before doing this numbers, let me do one quick thing. I would just format this in the way which I would prefer to see this. I would need a comma separator and I wouldn't need any decimal. If it is negative, I would like to have it in this format. So I covered these items. So now let's input the 2023 numbers first, which is in this column, that is 64699147216. With now this is just summation of these two guys. Then next one is 1784, 48059. Now total COGS is summing up these two numbers. Gross margin is difference between these two guys. R&D 25,795, 22,759, 75,75. Then operating income is this number minus summation of these three guys, which is operating expense. Then other income or expense and net. Then taxable income or income before income tax. Then provision for income tax is 16,950. 72,361. Yep, and we got this number. Similarly, I will quickly input the number for 2024 and 2025. Perfect. So now what I did is I just provided the input of the historical 3 years, that is for 2023, 2024 and 2025. Now let's start to forecast what can be the potential, what would be the future, that is for the next 5 years. For that, the first line item is total revenue. So first, to figure out the total revenue, what I would do is, there are multiple websites where analysts who breathe in and breathe out in this financial world, they will try to analyze and estimate what will be the future revenue for each and every year. There are multiple websites like Yahoo Finance, Simply Wall Street, Bloomberg and others. For this video, I will just get what is the future number which analysts are predicting from the Simply Wall Street, because that is free version. It's not any paid website, and also we will get we will get the future number for next 3 years. So what I will do is I will just go to the Simply Wall Street. Then I will just type in Microsoft. Here it is. Then come to the future growth section. Here you could see on the trailing 12 months what is the revenue which the analysts are estimating. So if you could see, as of this number which says June 29, 2025, the revenue is $281 billion. That is the revenue we are seeing here. So, and similarly we will see for June 2026 what is the numbers which the analysts are estimating. So if I go here, this is for June 2026, the analysts are estimating $326 billion. 326,836. So I'll just type in this number 326836. This is the revenue which analysts are estimating for 2026. And if you could note, 51 analysts have done it. On average, it is coming up to 326. There can be like some analysts could have estimated up to $350 billion. Some analysts could have estimated as low as $300 billion. But for now, as a street case, let's take the number which we have now. Then by end of the video, we will even in turn break these numbers and make sense out of it. Then for the next year, which is June 2027, analysts are estimating $375 billion. I'll just put in the number 375,788. Then for June 2028, expectation is or estimates is 435,309. 435,309. Might be, please note, I will just put a note, all the dollars are in millions, because even if you go to the income statement, this is the income statement we did, and if you note it, they have mentioned all numbers are in millions except for share amount. So whatever number I'm putting in, it's everything is in millions. So we did this. Maybe for the next 2 years, this website doesn't have any information, but there are some websites which provides the estimates for even next 2 years, which you're looking, that is 2029 and 2030. But since I don't have a subscription, I have a subscription, but just to make this video generic, I'm not going to get that number. What I'm going to do is, I will see what is the year-on-year growth which the analysts are estimated for the revenue for these 3 years. Then try to see what is the trend and try to project it for the next 2 years. That's what I will do. So for this, now I'm going to go here and type in revenue growth. So for this 5 years or 6 years, I will just evaluate what is the revenue growth. Here we cannot do it because we don't know what was the revenue for 2022. So I'm just going to shade this out. Then here I will just start doing what is the revenue growth percentage. And we'll just do this, and I want this row as a percentage because this is not a number, this is a percentage. So from 2023 to 2024, the revenue has increased by 15%. Then 2024 to 2025, 15%. For a company with the scale of Microsoft, 15% revenue growth for the last 2 years is magnificent. And as per the analyst expectation, they are seeing the revenue to grow at 16% in the next year, 16.01 to be precise. Then 2027, it is about to be 14.98%. Then the next year, it is about 15.84%. So the analyst, on the average, they are expecting in the next 3 years as well, the company will grow 15%. And there is no harm, or what we can assume is even for the 2029 and 2030, the company can grow by 15%. Or if we think whatever Microsoft has been spent as of now and whatever they are going to spend in the next 3 years on AI, will that highly beneficial them? In that case, the revenue can even grow higher than 15%, say 18%. But 18% is too high considering the scale of the business which Microsoft is in. On the other hand, we could also argue, I think that's the hot topic right now in the market, that lot of the investments which the companies are making on the AI might not get monetized. On this end, you could say, you know what, 15% is not possible. It can only grow 12% for the year of 2029 and 2030. So we can argue multiple assumptions, but for now, to be on the very safer side, I'm just going to assume Microsoft will grow 12.5% for the year 2029 and 2030. With this assumption, I'm going to do. But again, by end of this video, I will do a sensitivity analysis wherein I will try to increase it or try to plug in bull case scenario and bear case scenario and see how the numbers looks like. Now, I know what is the 2028 actual revenue, and I am saying that it will be for 2029, the revenue will be 12.5% year over year growth than 2028. I can just multiply this by 12.5 percentage and get what is the next year growth. But rather than doing it, I'm just going to do a small tweak here. We know the percentage growth which is expected from analyst is 16%, 14.98. I'm just assuming 15, and next year it's 15.84. I'm not going to calculate this, rather than I'm just going to input as a number. The reason is, by end of a day, by end of this video, I will even sensitize what is the revenue growth. So it won't help me. It wouldn't, like, technically I can't make sensitivity analysis if I'm just calculating what is the revenue growth year over year. So I will type in the numbers here as 16%, 15%, and 15.5 or 15.84 to be precise. Then calculate the revenue numbers. Then I will do the rest of the item so that it will be helpful for my video. Maybe let's do that right now. So I'll just take out these numbers first. 16, 15. I'll just type in 16%, 15%. So this is the number which I have seen. With this, let's start calculating the revenue for the next 5 years. We are good. So now we know what is the total revenue. With this, we can calculate what is the COGS. To calculate the COGS, we know we have two line items, one as product COGS and another one as service COGS. So to make my analysis more detailed, I will even first calculate what is the revenue which is contributed from product and what is the revenue which is contributed from service and others. So I will do that first. Revenue from product, revenue from service and others. So first what I'll do is I'll try to understand how much of product segment has contributed to Microsoft total revenue. So I'll just divide these two numbers. Maybe I will I know I'll further do some more percentage, so I'll better put it as percentage here. And I would see for what is the numbers for last years. Similarly, I will try to understand what is the service and others contribution to total revenue. So by just looking at these two numbers, what we could notice, product contributed around 30% in the 2023. Drastically, it has reduced to 22% in the most recent year. Whereas revenue sector, it was around 70% in the most recent year, is now 77%. Might be by end of the day it need to be 100%. So what I would do is, in my opinion, might be if you could read through the entire annual report, you could understand what are all the segments which contribute to product. And I really don't think product will be the much contributing segment even in the upcoming years, whereas service and others will be the most contributing factor. So for this, what I would do is I will do a step function, like as of the most recent year it is 22.7%, and I'm assuming that the product's contribution to total revenue will reduce by 1% or even 1.25% in the next 5 years. So I will put a step function and I will put a say 1.25%. It's going to increase or reduce. So okay. Then similarly, I would say the product would grow by this number. Again, this is my assumption based on what I understood from Microsoft Business. You could argue that this number might differ, or product can be still 22% for the next 5 years, and service and other can be the same 77% for further 5 years, for the next 5 years. But I would stick to my assumptions and go ahead in calculating what is the revenue of product and revenue of service and other segment. So I got this and I got this. As a sanity check, just make sure by summing up these two numbers, we are getting this number. Here, yeah, I'm getting 549372. We are good. Now, the next one is COGS. Again, I would evaluate what is the COGS of product alone. We have it in numbers, but I would like to see it in percentage. That makes more sense. Product COGS by product revenue. And similarly, I will do service and other COGS by service revenue. So would see what trend or how the numbers looks like. And then similarly, this number by this number. So let's see what is the trend. Okay. So here, if you could see by the product COGS, it was 27% in 2023. Then in 2024, it has been to 23%, and then most recent year, it is 21%. I really don't know if it will grow. I mean, go on the downside, like beyond 20% as a COGS for the product in the next 5 years. On a safer side, what I'll assume is the COGS of product for next 3 years is 20%. Then for the last 2 years, it's 19%. On the other hand, the COGS for service, I think the COGS will be higher for the next 2 to 3 years at least, because Microsoft and other pretty much top tech companies are doing a lot of investment these days on the AI. So I'm thinking for the next year, I mean, I'm just estimating it can be for 35%, 35%, and 36% in the next 3 years. Then again, it can come back to 35 to 34. Or if you are close to the business and if you have any insights better than this, I'm happy you can put your numbers, but I'm just going to stick with this assumption. Now I'm going to calculate what is the COGS in this case and then this case. So with this, we have got what is a gross margin. Then R&D, research and development. Again, a lot of tech companies are spending crazy amount in R&D these days. Let's first try to understand historically how much R&D they have. I mean, R&D as part of total revenue Apple has spent, and see what can be the future numbers. R&D as part of percentage of total revenue. So, a matter of fact, I'm going to do the same for sales and marketing and general and administrative. Marketing as part of maybe before that I'll just do some color coding so that I know, or as a general practice we know what is estimated and what is the. So let me do this one in much bluer. And then I'll just make the font as well. Okay, this one is let it be up in the white so that just not looking so generic. Okay, so now let's evaluate what is the historical R&D of Microsoft. So in the last 3 years, they have spent approximately 12% of their total revenue. Might be what I would assume is for the next 2 years, they would be spending around 12.5% in R&D. Then even for the last 3 years of our estimates, I'm just going to assume 12%. But if you have a different number, please feel free to update it. But I will stick with this number 12 and 12. Sales and marketing. Let's see how historical numbers are, and then see. It's 10.74, 9.98, and 9.11. It is coming in downhill, and I'm estimating, maybe before this I'll also come and calculate this number, general and administrative. Okay, if you see these two numbers, which is sales and marketing and general and administrative, these numbers are in downhill. And in my opinion, this number will still get lower, and I don't think definitely this number will get higher because recently Microsoft are doing a lot of layoff. So I'm thinking this number will go down. I'm just going to take again a step function here as 0.5 percentage for sales and marketing, and for general and administrative 0.25. So I'm just going to do this number. Minus this. I'm just going to anchor this one, and similarly I'm just going to do this and anchor this number. Let's calculate this. This number looks 6% in sales and marketing and 1.1%. So this number looks reasonable, but if to be on a safer side, I assume we will be spending a lot more. I mean, rather than assuming 0.5% as a step, I'm just going to take 0.4% and for this as 0.2% instead. So with this, we'll calculate the numbers in the dollar amount now. So what I need to do is multiply R&D with the total revenue and do this. Then multiply the total revenue with this number, then same here. So now we can calculate operating income, which is this minus sum of these three guys, and can forecast what is the value here. Now next one is other income or expense. I think till this time everything is an operational income. Other income or expense, let's go back to our annual report and figure out what Microsoft have meant by this other income or expense net. So for this, what I'll do, just copy this and type it, or there can be other better ways even to do it. So by doing so, we could see this table where table or footnotes might be whatever you wish you can call it. They have given a breakdown of what other income and expenses. If you know, remember in our annual report of 2025, other income or expenses negative 4901, that is the number you are seeing here. Then for 2024 it is negative 1646, that is the number you are seeing here. Let's see what are the breakdown of it. So they have given six items as a breakdown. First one is interest and dividend income. Yes, by end of a day, Microsoft as a company have a lot of cash sitting in them. They will get interest out of it. Microsoft have mentioned what is the interest as a first line item, which is approximately $2 billion in the most recent year. Similarly, interest expense. On the other hand, Microsoft also have a debt for which they need to pay a interest payment. For that, they have mentioned what is the debt payment out of it. Third one is net recognized loss on the investment, might be for on the whatever investment they have made other than Microsoft as a non-operational items. They have mentioned what is the net loss on it. Fourth one is net loss on the derivatives. Whatever derivatives on the 2025 they have given it. Then fifth item is net gains or loss on the foreign currency remeasurements. Yes, as a Microsoft, by end of it is a global company. They have operation all across the world. In that, they have gained approximately $171 million in the most recent year and lost $244 million. They have also provided this as one line item. And finally, they have mentioned other as one line item, which we don't know what it is. I mean, I read through this statement. I couldn't make sense out of it what constitutes another. So as a simple line item, this is not an operational thing. We could just simply forecast the same amount which they made in the previous year. They are going to make it in the next 5 years, but that's not a best practice, because by end of the day we will calculate what is the total cash Microsoft have for each and every 5 years. Similarly, what is the total debt Microsoft is going to have for the each 5 years. With that, we will get what is the interest income and what is the interest expense. But rest of these four items, which we don't know what it is, we could take an assumption that it is going to stay the same as what is in the current year or in the recent year. So let's try to capture this and also put it in our Excel and work through it. So first what I will do is I'll quickly type in these 6 line items here. Then finally other. So these are the 6 line item. Let's fill in the numbers as well here. So now let's calculate the sum of all these items first. 1646 and then perfect. So now what I do is as mentioned, we will get what is the cash and debt by end of this modeling, and we will know and we can calculate what is the interest income and what is interest expense. But for other items, since we don't know what is the number going to be, I'm just going to forecast or assume whatever is in the last year is going to be the same. Or even to a simple assumption, you could just assume all these 4 line items for the next 5 years is 0, but I don't think it's going to be realistic, so I'm just going to put in some numbers. So I just have these numbers. Then these 2 items I'm not going to input now. I'll come and update it later. So for now I'll just give it a different color. I'll just mention will be referred from interest income schedule. This will be referred from interest expense schedule. Okay. So now what I would do is I will just link these numbers here. That is this numbers for the next 5 years. Perfect. Now we just have last 2 line items, which is income before income. I mean income before income tax. So which is just summation of these two guys. With this, then provision for income tax, which is nothing but how much tax uh, the company has paid in those 5 years. I mean, we need to evaluate how much the tax could have been paid. For this, let's first evaluate what is the tax rate for the last 3 years. For this, I'll just come here, just put in tax rate. Tax rate is what is the tax they have paid by the taxable income. So with this, let's see the numbers. We could see for the last 3 years, on an average, they have paid around 18%. I mean 18.98 to be precise on 2023, 18.23 on 24, and 17.63 on the next year. So what I would do is I will just take average of these 3 numbers and assume this is going to be the interest for the next 5 years. Or you could come back and say, 18% is too high. We know statutory tax rate for the US companies is 21%. You could argue 18 is too high. It will be around 15 or 16. And on the other hand, some argument can be Microsoft is doing a lot of business outside US. There can be higher tax implication. Those things I'm not going to consider now. I'm going to consider it in the sensitivity analysis. For now, I'm just going to take this number and put it there. So evaluate that this multiplied by this minus this number, something wrong. No, okay. Tax rate is just this multiplied by this and then forecasted. Then now this is the difference between these two numbers. Perfect. So now we did the income statement modeling. With this, we calculated what will be, I mean, how will the income statement for Microsoft will look like for the next 5 years. Let's evaluate, I mean, we have considered or we have calculated net income will be $115 billion in 2026. Let's try to evaluate with what the analysts are saying in this simple version. So here analysts are estimating earnings, that is, you could see, might be, yeah, you could see in 2026 we calculated 326, I mean, we took the numbers from here, 326, and earnings, which is nothing but the net income, analysts are mentioning as $117 billion, whereas as per our calculation it is 115 billion. We are close, but we yet to need to provide net income, I mean interest income and interest expense, but still we are on this range. Then for the next year, 2027, net income is $138 billion. Ours is $134 billion. That's fine. Then for the 2028, it is $162 billion. Our number is only $154 billion. Uh, Indeed, it's on the lower end, but I wouldn't mind considering it in the lower end because I will stick to my numbers. Uh, or I think, yeah, I know I might why the number is slightly lesser, because while I previously calculated it for the 2028, the growth rate was around 15.85%, but to be on the safer side, I assumed 15.5. That might be the reason. But still, we are not entirely outblown out of the range of what analyst is thinking. At least for the last next 3 years, our net income is in a closer proximity range. So with this, let's also finally do one more thing. Let's calculate what is the net income, because we know what is the net income for these 3 years, and evaluate whether are we in the range or entirely out of range. Okay. Historically, in the last 3 years, it's around 35-36% is the net income. Then in the next 5 years, what we are saying is, or for our estimated years for the next 3 years, it is around 35%. But in the last 2 years, our estimate it's around 37 and 38%. It's on the higher end, but I hope Microsoft gets to this number, and me as a Microsoft shareholder getting benefited out of it. So I think this is what I wanted to do for the income statement modeling. So with that, let's get started. I have the most recent 10K, and in that I'm specifically interested in the balance sheet. I have opened it now. So with that, first what I'll try to do is uh, first put in what are all the line items which has been provided in the balance sheet of Microsoft in the most recent year, both in, I mean, in the assets, liabilities, and the shareholder equity section. Then input what are all the historical numbers for the last years. But for now, what I will do, I will just input all these informations into my Excel and start forecasting for the next 5 years. Might be what I will do, I will fast forward this video from here all the way till I input the numbers. Then once I input all the numbers, let's continue. So with this, let's get started. Okay, perfect. So with this, what I did is I have updated, or I have captured in our Excel document what are all the line items for assets, what are all the line items for liability, and what are all the line items for shareholder equity. A note, uh, in the assets they have captured, or they will have one line item as total current asset, and similarly when it comes to liability they will have a different line item as total current liabilities. These two items I haven't captured in my document because I think, or I feel, for our purpose or our analysis, those two numbers are not needed. Other than that, I have captured everything. Even before I start forecasting the next steps, one basic equation might be our first class in finances. Whatever business we are doing, the assets, which is the asset, should be equal to the liability plus shareholder equity. So this is the formula, or this is the equation which we will use to ensure once we forecast our model, or once we fully develop our restatement financial model, our model is balancing or not. So for that, what I will do is I will add one line item as balance check, and I will just put in our asset should be equal to sum of liability plus shareholder equity, or if I rearrange it, it is just the difference of these three things should be equal to 0. So now, since it will be for these 2 years, it will be 0 because this is already audited and from the official Microsoft website. But our challenge would be for the 5 years which you are going to forecast, ensure it is balancing. Maybe I will do one thing. I will add a round function here, because whatever number we are going to get, we will get something in decimals. So I don't want that to be a small issue while we come in. So I'm just putting round of total asset minus total liability minus shareholder equity rounded to 3 decimal places. This is the function which I'm just going to use. So now with all these informations available, we will start forecasting for each and every line item. What would be an assumption which we are going to take to forecast it. First one, cash and cash equivalents. I'm not going to focus anything for this now, because by end of the day, or after this balance sheet, we will do the cash flow statement modeling. The last line item of cash flow statement modeling is nothing but how much cash has been generated by the company. So it will be wise to hold on updating or calculating anything on cash and cash equivalents for now, and come back and update once we complete our cash flow analysis. So for now, I will just put it in this color code, and I'll come back later and I will take a note. Will be referred from cash flow statement, cash flow statement last line item. Next one is short-term investments. So the short-term investments is nothing but the funds which Microsoft as a company have invested in other equities or in other treasury bonds or bills, which is going to be maturable within next 1 year. So if you see for the last 2 years, the number has been increased from, it was $57 billion in 2024, and in the current year of 2025 it was around $64 billion. We can assume that it will even further grow in the upcoming years, but already they have $64 billion in the marketable security as a short-term investment. Even that's a very huge number. So I'm not going to increase that number further, and what I will do is I will still assume that the number is going to be the same for the next 5 years as well. So it's nothing but I'm just going to assume a straight line growth. There is neither increase nor a decrease. But if you think 64 billion is too high, they will sell something and take out a cash, you could absolutely do it. But for now, I'm not going to complicate things. I'm just going to keep it simple, assuming a straight line assumption. So this is straight line growth. Next one is account receivable. For account receivable, you could see in the year 2024 it was $56 billion, and the year 2025 it was $69 billion. You could see the number is increasing. But technically, if we see what is an account receivable is, say Microsoft as a company or a business is selling their products or service to the customers. It is how much of the products or goods which they sold, or the company yet to collect the cash out of it. So that is the accounts receivable number here. So the most logical way to do the accounts receivable is calculate what is the days sale outstanding for the last 2 years, and try to average those days sale outstanding for the next 5 years, and then calculate back the account receivable. So might be what I will do is I will type in account receivable equal to the DSO into the credit sales by 365. Might be technically it's the total days in the period. Since we are talking about annually, I'm just going to put the 365 years. So now first we don't know what is the DSO to calculate for the next 5 years. So for this, what I'm going to do is see what is the DSO for the last 2 years and average that number out for the next 2 years. So what I'm going to do is DSO for the last 2 years is, it is nothing but just doing the other way around, accounts receivable into 365 by credit sales. So in the Microsoft, or to a matter of fact, a lot of companies, they don't explicitly mention how much revenue or how much goods they have sold in the credits. But we know what is the total sale. So since we don't have that exact number of what is the credit sale, I'm going to take the total sales or total revenue as a proxy for it. So if that is the case, how this DSO will look like is accounts receivable. In this case, this is this number into 365 divided by the total sale, that is this number. So we could see the DSO for the last 2 years is 85 and 91 respectively, and I think it's better to assume what is the average of the last 2 years as the number which will grow for the which will be the same for the next 5 years as well. I'll do this. So now we have assumed the DSO for the next 5 years will be 88. With this, it's easy to plug in the total credit sales. In our case, the proxy is total revenue divided by 365. We will get what is the account receivable. So now DSO, which is this guy, multiply it with credit sales, which is this number by 365. So we are getting this number. So now account receivable is done. The next one is inventory. That is, in the short term, how much inventory the company hold. You could think it of two ways. Inventory, as the business grows or as the company grows, the inventory as will grow. That is, either the raw material needed to manufacture their goods or products, or the products which are completed. So I would assume inventories will grow with what is the revenue growth which you have forecasted for the next 5 years. So revenue growth is here, and I got the number, and the inventory is this one. Okay. The next one, other current assets. So other current asset is like within a short period of time, like within 1 year, they might have some assets. That is where which comes in other current asset. I would also assume that the other current asset will also grow by what is the revenue growth rate, or you could even simply say that other current asset might not even grow, it will be with the straight line. Either way, you could take a simple assumption. I mean, either way, you could assume what might be the better number. But for now, I would assume the other current asset will be the same, neither increasing nor decreasing for the next 5 years. Next one, PPE, which is property, plant and equipment. So to understand what is the total PPE by end of this year, we need to first calculate how much the company is spending on capital expenditure. Capital expenditure, which is nothing but purchase of property, plant, equipment, we will do only in the cash flow statement. So for now, I'm not going to touch this. I'm just going to color code it and mention referred from PPE schedule, PHEDU, which we will develop in later. I'll take a note here, and this is grown with revenue growth, and this is straight line growth. Next one, operating lease right of use assets. So what this number mean is, say Microsoft could have leased some of the assets or property to use in the long term, so which they could have prepaid much before this time. So Microsoft is giving how much they have paid it before, or which means $24 billion is the operating lease right of use asset in 2025, which is approximately $24.8 billion. They have it in asset which they already paid it to the customers or vendors, which they can use it in the further days. So for now, I would think it's better to straight line it, because maybe I would consider this number will grow by the total revenue growth which we calculated for year over year. So I will do this one with this number. then forecast. Then next one is equity and other investment, which is, as a business, Microsoft have invested on non-operational part of the Microsoft, that is in other companies or other businesses. There might be Microsoft have invested hugely on OpenAI. All these items will come under this bucket. So I'm thinking Microsoft is in growing state, so I assume this number will also grow as per how the revenue will grow. I'm just going to use the revenue as well as a proxy here. So these two things we have grown with revenues. I'm just going to update it here. Next one is goodwill. Goodwill, I think this is one of the most complicated part. Goodwill is nothing but the amount or the cash which the company could have paid in excess to purchase another company or business. Say example, Microsoft purchased Activation Blizzard couple of years. They might be, the market value could have been say $8 billion, but I think they purchased for around 9 billion. I mean, I don't remember the exact numbers, but say if the market valuation price of the acquiring company is $10 billion, and if the company have paid $11 billion, the excess $1 billion will come in the goodwill here. So this is something which we can't even predict or forecast unless until we know what the company is going to buy. So on a very simple side or safer side, I will assume this number will be the same for the next 5 years, neither increasing or decreasing. So this will also be a straight line growth. Then next one is intangible assets. Intangible assets are something which the company has as an asset, but it is not valuable or not valued. Like it can be say some patents, some copyrights, or some brand value or some customer value. I would think that number will also grow by well, I think this number we don't know whether this intangible asset will be the same or not. We don't have much visibility. So on a safer side, again, I am assuming this is going to grow by the straight line. Then finally, long-term asset. Microsoft, yes, is in rapidly expanding state. So I assume the long-term asset will also grow by the revenue growth over the period of time. I'm just going by this simple assumption here. So this is done. So now we know, have calculated all the line items for total asset except the cash and cash equivalents and property plant equipment, which we will come back later and update it. So rest of the other than this, our asset section of the balance sheet is completed. Now let's move to the accounts payable on the liability section. Similarly, how we calculated the accounts receivable, accounts payable is nothing but the as a Microsoft as a business, the cash which they need to pay to their customers, or I mean not customers technically, it would be most likely the vendors or suppliers for the goods or service they already got. So for this, the how we calculated account receivable, the formula is accounts payable equal to COGS, which is our cost of goods sold, into DPO. There we have a DSO, which is days sales outstanding. Here it is DPO, which is days payable outstanding, by 365. So the same analogy like account receivable, we will calculate what is the DPO, that is after how many days Microsoft is paying back to the customers, or sorry, paying back to the vendors and suppliers, average the DPO, then come back and calculate the accounts payable. So now the DPO is accounts payable is here into 365 divided by cost of goods sold, this number, which means Microsoft is paying after approximately 108 days and 115 days in the last 2 years for the cash which they have liable to pay to their vendors and suppliers. So now we will take average of these two guys and then assume this number will be the same for the next 5 years. With this, let's go back and calculate what is the accounts payable number. Accounts payable is the COGS, which is this number, into the DPO by 365. So let's project it. And then next two items, which is short term debt and current portion of long term debt. And also, if I will just quickly jump in a line here, we also have a long term debt. All these three debt items, I think it needs some special attention, which I think it makes more sense to look at while we go to the cash flow statement in the next part of the video. So for now, I am not going to update anything. I'm going to color code these three items here. From, I'll take a note from debt schedule. I'll put refer from debt SCHEDUA. This is the same here. Okay. Next one is accrued compensation. This is nothing but the expense which has already been need to be paid to the employees of the company, but Microsoft hasn't paid it as of now. So I think this number as a business grows will also increase. I would assume this number will grow by the revenue growth which you have calculated. So what I would do is multiply it with revenue growth here. Okay. Next one is short-term income tax. That is how much the company needs to pay in a short term, like in the next quarter or next 2 or 3 quarters. Uh, for this, since we know what is the long-term income tax which the company have paid in the last 2 years, I will try to understand how much of the short-term income tax is the ratio of the total income tax and take that percentage. So what I'm going to do is short-term income tax by total income tax. Let me figure out that ratio first here by this number. Okay, so we will get a number, might be, let me make it in percentage. So it was like 25% and 39%. I will put this one as percentage. So I'm just going to take approximately 30% or 29.31% to be precise of the income tax Microsoft will still be liable to pay it as the short-term income tax here. So I'll come here and update this number here. Next one is short-term unearned revenue. Short-term unearned revenue is nothing but, in simple words, it's also called as a deferred revenue. Say, assume you are purchasing a Microsoft subscription. Say you are purchasing the Microsoft subscription on 1st of January 2025. Then that subscription will be for 12 months or 1 year. But say, assume that Microsoft is going to close their fiscal year by June 30 of 2025. Then for the next 6 months, which is going to be the next fiscal year for Microsoft, they are liable to pay you or provide you the service for which you already paid in the last year. So that cash or whatever cash that is coming under that bucket will be coming under the unearned revenue, or in simple words, it's deferred revenue. So what I would do is calculate what is the total percentage of this revenue, what total percentage of revenue is contributed in short-term unearned revenue, then forecast the same for the next 5 years. So then put it by total revenue and then do this. So it is approximately 23.49% in 2024, 22.91% in 2025. So it's approximately 23%. I would use the same number as next 5 years as well, which is equal to this guy, multiply it with total revenue will give you some number, and this is this number. And then next line item is other current term liability, which I think it will grow as the company grows in the business. So I would grow it with the revenue growth here. Then next one, long term debt, we mentioned we will update it, come back and update later. For now, let's move it to the next step, which is long term income tax. Uh, so what this means is how much the companies expect to pay in the long term income tax in the next 1 year. Maybe what previously we saw is the short term income tax that is payable within 12 months, but the long term income tax is which is greater than long 1 year. We could do the same what we did for short term income tax, but I think for simple assumption I'm going to assume this number will be the same for the next 5 years. It's not going to neither increase nor decrease. Then similar to the short term unearned revenue, Microsoft have also reported one line item as long term revenue. So I'm going to do the same analogy here, divide it by total revenue, figure out what's the number and assume that is going to grow further. Then this one will be average of these two guys, and then everything should be a percentage. So it's just like 1% of total revenue. So I'm going to do the same, multiply it with the total revenue. So we'll get this number. And the next one is deferred income tax. Even here, we don't know how much it will be a deferred income tax. So I'm just going to take an assumption it is going to by the straight line. Might be I will take a note how did I calculate it. This is straight line growth. Copy this. This is sorry, not straight line growth. This is grown with revenue. I think I need to come back and update this one. This is also straight line. Okay. And the next one is operating lease liability. Might be yes, Microsoft as a business could have took a lease to perform their business. For that, how much lease liability they have. And I'm 100% sure this number will increase going forward. They will even take more plans or operational space to increase their business. So I'm going to grow this with revenue. Similarly, liability, as the business grows, the liability will also increase. So I'm just going to do this growth with the revenue. That's then I'm going to calculate the total. That's so I'll just make this coloring a bit so that we know what it is needed for the. This is done. Then finally, what we need to do is common stock and paid in capital. Maybe if we go to the shareholder equity and come to this page which says shareholder equity statement, this will show in detail what is this three line items of common stock paid in capital, retained earnings and accumulated comprehensive loss. Common stock in paid, capital paid, if you see how it is calculated, balance beginning of period plus the common stock issued less with common stock repurchased and then subtracted with stock based compensation expense. So right now we don't know what is the repurchase, what is the share based compensation. These two line items will come while we do the cash flow statement. So let's hold it off now and come back while we do the cash flow statement after we complete the cash flow statement. Similarly, for the retained earnings, how it is calculated is balance beginning of period plus net income plus common stock cash dividends plus the common stock repurchase. Even dividends and repurchase, we will get the numbers while we do the cash flow statement. So let's hold retained earnings as of now as well. Accumulated other comprehensive loss, it says balance beginning of period and other comprehensive loss or income. Might be I went through Microsoft annual report thoroughly. They haven't mentioned what is this other comprehensive income losses, and I don't think we can take any guess or assumption to calculate the number. So for now, what I'm going to do is Other comprehensive loss, it's going assuming it is going to be the same for the next 5 years. There is no change in it. And the common stock paid in capital and retained earnings, I will come back and update after I complete our cash flow statement. So with this, I will just do this and update this space. Okay. So with this, pretty much our balance sheet is done. The open items in balance sheet are cash and cash equivalents, property, plant, equipment, uh, debt, debt as in short-term debt, current portion of long-term debt, and long-term debt, and then common stock paid in capital and retained earnings. These are all the 5, or I would say 6 line items which is open, which we need to come back and update, or we will get to know much once we get into the cash flow statement. So first, let's be sure on how the cash flow statement structure looks like. For that, let's go to our cash flow statement. I mean, in the most recent 10K, let's go to the cash flow statement. Okay, here it is. So as we would know, or I assume we will be very clear now, cash flow statement will have 3 sections. The first section is cash flow from operation, second section is cash flow from financing, third section is cash flow from investment. In the operation, it will start with net income, then add back the non-cash expenses, and then update the change in operating asset and liability. So whatever the cash flow from operation is, it will be only 3 steps. Net income, adding up the non-cash expenses, and third one is the change in the operating asset and liability. Then in financing, we will be able to understand how much the company have, you know, if the company took any new debt or repaid any existing debt, or the Microsoft as a company, they provide dividends year over year. And on top of it, Microsoft also mentioned they are doing some repurchases and they have given the amount. So we will calculate what might be the repurchase rate and all the expense which are spent on the financing activity in the financing section. Then finally, investing, it's most probably going to be additions to the property, plant, equipment, or in simple words called as capital expenditure. So let's start building our cash flow statement for Microsoft. The good thing is we don't want to input line by line items in this cash flow statement and input all the historical data. So there is a very simple way, or there is more efficient way to do it. Let's get started with it. So with this, now let's go back to our Excel workbook, and I'll first copy this. Let's say this is cash flow statements. So first, as I mentioned, the first one is operations. Cash flow from operation, So it starts with net income. Then next one is share based compensation expense, which is one of our non-cash expense. Then next one, let us see what it is. Stock based compensation, might be I mentioned as share based compensation or stock based, so it's fine, but I'll stick to the same name. Next one is depreciation and amortization. And amortization. Then we have these 2 items: losses on the investments and derivatives, deferred income tax. These 2 items which we don't have much insight, so I'm not going to consider here. I'll just go to changes in operating assets and liability. Even here, rather than I put change in operating asset and liability as one section, I will put it in 2 sections. Change in working capital asset, change in working capital liability. So what I'm going to do is here the 10K report have one huge section as change in working asset, operating asset. I'm calling it as working asset, both are similar. Working asset and liability. Underneath it, they have provided all the items. But what I'm going to do is I'm just going to do it in 2 lines. Calculate the total assets change in working capitals and calculate change in working capital liability, so that it will, my model doesn't look that great, but by end of it I'll capture all the assets. So now what I would do, I would do the summation of these things and get what is the cash generated from operation. I'll put this cash generated from OPE or rational operations. So this is the first section of our cash flow statement. So now let's input the numbers here. So we already calculated what is the net income for the next 5 years, which we will directly link it here. So the net income is this guy, link it here. Next one is stock based compensation expense. First we'll come back to our 10K and input what is the last 3 years of stock based compensation first. If you look at the numbers here, it is 9611 in 2023, then 734, then 11974. So this is the numbers for the last 3 years. So to forecast this, what assumption I would take is, by end of the day as a company grows, the stock based compensation will also be there. Like most likely the stock based compensation, at least for the small scale companies, will be tied with how much the company performs, how much revenue they make, and how much net income they generate. For this, what I'm going to take is the stock based compensation is going to grow in line with what is the revenue growth. So I'm going to take that assumption and put it here. Next one, depreciation and amortization. For this, let's go back to our 10K and input what is the historical number first. Depreciation and amortization in 2023 it is 13,861. Next year 22287. Next year 345,153. 34153. So now I wouldn't forecast anything for depreciation and amortization as of now. The reason is depreciation is for the property, plants and equipment, that is the tangible asset, and amortization, as we don't know exactly what it is going to be, it's most likely for the intangible asset, which we will get to know later part of this cash flow statement. So for now I am not going to update anything. I will just color code it and come back later and work on this. Then next one is change in working capital asset. So first let's go back to our balance sheet and figure out what are all the working capital asset. This is the same way how Microsoft have also did it. If you see, account receivable is an asset, inventory is an asset, other current asset, other long term asset, everything here comes under the asset section. And then we have accounts payable, unearned revenue, income tax, other long term liability. These sections come in the liability section. So similarly, first now we will figure out in this section what are all the working capital asset. So here we would short term investment is not a working capital asset because it's have been already invested. Accounts receivable, yes, it's a working capital asset. Inventory is a working capital asset. Other current asset is a working capital asset. PPE is not a working capital asset. And whatever items here, these are all not a working capital. This is long term. And one thing, even though other long term assets, if you take a look at in the 10K report, it is coming as a change in operating assets and liability. I am specifically taking what is the working capital, that is operational items. Even though yes, long term assets are also operational, but I'm not going to consider it. I will put this as a investment activity because I feel it makes more sense for me to put it there. So that's what I would do. I wouldn't consider anything here as a working capital asset. And to be very clear, I think this is where if you are doing it for the very first time, you will end up with a lot of mistakes. While we calculate change in the working capital assets, increase in the asset should be, increase in the asset is nothing but cash is going out of the company, which is you are spending some cash to purchase some assets. So that is how the formula should be. So it is nothing but difference of previous year with the difference of current year. Or if you want to do other way around, just make sure you include a minus before, that is negative of sum of the current year's working capital asset with the previous year working capital asset. So this should be the right way to do it. With that, let's start putting the formula. I will do this way: sum of these three minus sum of these three. We will get what is the working capital asset, and we will do the same for the next 5 years. Next one, working capital liability. Now let's go to the liability section and figure out what are all the working capital liability. Accounts payable is a working capital liability. Short debt and long term debt, these two items are not working capital liability. Accrued compensation is a working capital liability. Income tax is a working capital. Unearned revenue is a working capital. Other current liability is also a working capital. And long term debt, rest of the items, I wouldn't put it in the working capital section. Now let's come back and do the difference here, and vice versa to what we did for the assets. If the liability is increasing, which means the cash is going out of the company, so we need to do other way around for how we did for the assets. Might be take a moment to digress this, because if we do this wrong, by end of the day our model won't balance. So I will do this plus sum of these guys minus this plus sum of these numbers. So we will get to this one. Okay, I think this is what we need for cash generated from operation. We will calculate the sum and we would close this out. Perfect. So now let's move ahead to the next section, which is cash flow from financing. So financing, we could see what are all the items: proceeds from issuance or repayment of debt, proceeds from issuance of debt, repayment of debt, common stock issued, common stock repurchase, common stock cash dividend. So these are all the items which we are going to do. Here I am going to leave aside common stock issued, because indeed you can take that assumption as a common stock issued, but for simplification I am not going to assume or consider any common stock has been issued. So with that assumption said, I will start putting this one. Repayment of debt, new debt taken, then dividends paid, stock repurchase. I think I have updated everything here. Repayment, proceeds from, okay, maturity of 90 days and left. Okay, I think they have classified two items: proceeds from issuance of debt and proceeds from issuance of debt for maturities 90 days or less. If you remember, if I go back to our balance sheet, we have short-term debt. Short-term debt, or it's also called, sometimes called as commercial paper. You could take a note of that one as well. I am just putting that, and I will add one line item here as commercial paper. Then what I would do is current portion of long-term debt. I think okay, let's have it as it is and come back later. Then if we do the summation of all the items, we will get cash used in investing activity. CPI. Okay. Then the next one is investment activity. Investment activity is simple: the purchase of PPE, or in some words it's also simply called capital expenditure. Then investment in non-current assets, investments in, well, I wouldn't say investment, I would rather call it as change in non-current asset and change in non-current liability. Let's see also if we are missing out anything. Yeah. So here we need to also, since we are doing the reconciliation, we are missing out these guys. That is operating lease write-off assets. This is pretty much an long-term operation. I'm thinking where it should be the best way to put it. Equity and other investments. I think I will put this in the cash flow from operation, but it's not a working capital or a short-term thing. So what I will do is I will just use this, then put this change in operating assets, which is nothing but difference of this year minus previous year, and then do the summation. Then let's take a note. This is already went in cash flow from operation. Equity and other investment, I think the best way to put it, this one is investment activity. So we will do that. Investment activities here, right? So let's put this. Change in equity and other investment. Which is some more difference between this one and this one. Then spent in cash flow from investment. Then the next two items, technically we should put it in the cash flow, but since I assumed it is not going to grow, it is just going to be a straight line, it doesn't make sense even if we put it there. So I'm not going to add it anywhere in the cash flow statement. I'm just going to put not applicable, not applicable here. Same with short-term investment. Then other long-term asset, this is the financing activity which we already put in here. So this is coming in cash flow from finance. This is the, so we have made sure every item in total asset is covered in our cash flow statement. Similarly, let's do for our liability. Short-term debt or commercial paper, we already put a line item here in cash flow from investing. Then similarly, this first, I will add one line item for this one as well. Change in current. Okay. So these two items went in cash flow from investing and cash flow from investing. Then long-term debt, we will have it. That is pretty much the new debt taken. We will put it there. That's already in the investment activity. Then long-term investment, sorry, long-term income tax. Since we assume it's a straight line growth, it's not necessary to reconcile again. It should, we can add it as a line item, but by end of the day, since we are going to do a change in, it's going to be 0. But we need to put long-term unearned revenue. Deferred income tax is might be, let's put this not applicable because these two are same. Then operating lease liability and operational long-term liability. I think these two items we need to put in, but we can add it here itself. Change in operating lease liability. These two I mean I did this one. I need to figure out lease or long-term liability, other long-term liability or current liability I would call it. that would be coming up here. So this is already taken care in cash flow from investing. And unearned revenue, we need to put it long term unearned revenue, that should also be in operation. Change in long term unearned revenue, which we will calculate it first. Okay, so this went in cash flow from operation. So might be, this could have been a bit of confusing, but make sure you did this right. The key item or the key thing to take care is ensure whatever items you have in the cash flow statement is reconciliated into the, whatever item you had in the balance sheet is reconciliated into the cash flow statement. If you do this right, pretty much your model should standardize. I hope I did everything right without missing any calculation. Let's continue our work and ensure our model is balanced. And a note, if you see here, I just summed up these 4 rows, but since we now added few more rows here, we need to ensure everything is supported. Okay, now let's come back to maybe I'll do this one. Cash used in financing activity. Then finally we will have cash generated by end of the year. This is nothing but summation of the 3 cash flow sections. So now let's try to figure out what can we do for repayment of debt and new debt taken. So typically, if you go to the Microsoft 10K report, there is this footnote which I mentioned the following table outline maturity of the long-term debt including the current portion. And they have given in 2026 they need to pay $3 billion, 2027 they need to pay $9.2 billion, 2029 they need to pay approximately $2 billion. So we need to build a different or separate schedule to update what is the repayment of debt and the new debt taken. For now, I would not do it because might be I'll first get the skeleton of cash flow statement. Then might be in the next part of the video, we will develop a detailed schedule and see how the numbers is coming up. These 2 items I have completed. Then I would do the same for the commercial paper because by end of the day, commercial paper is also a form of debt. I'm not going to do anything. But now what we can do is update or work on what is the dividends paid and stock repurchase. We will go back to our cash flow statements. And see what is the dividends which Microsoft paid in the last 3 years. So common stock cash dividend pay, this is the number I was looking for. It is $19.8 billion in 2025. We'll type in the number here first. 19,800, 21,771, 24,802. And similarly, I'll also put in the stock repurchase, which is common stock repurchase. I'm just using the synonym of it. In 2023, they have spent 22,245 minus 22,245. Next year 17,254, and next year it is 18,420. So with this information, let's try to forecast what is going to be the dividends paid for the next 5 years. One best and the simple way to do is to forecast the dividend. It's not by growing with the revenue. We will calculate the payout ratio. Payout ratio is nothing but how much dividend they have paid by the net income. Let's see how the payout ratio is for the last 3 years, and let's try to take the average of it and forecast it for the next 3 years. So payout ratio, which is dividends by net income. And then similarly, we have our stock repurchase. by net income. We will do this because I will tell you how I will figure out what might be the best way to do. So now these two things I want to see in the percentage. I will first make that formatting change, and I will include a negative because everything is here negative, and divided by net income, which we know already from our historical data, and do this. Then I will also do the stock repurchase by the same net income. So what we could see is the last 3 years the dividend payout ratio is approximately 27 25 percentage, and stock repurchase for the last 2 years was around 20 percentage of the net income, and 30% in the previous year. Why I would take a look at it in togetherness is how much the company is returning back their earnings to the shareholders, either in a form of dividends or a month quarterly dividend or an annual dividend, or stock repurchase by purchasing back the stock existing, they are increasing the equity value. So these two items are how much the company is giving back to the customer based on their total net income. So that's why I look at it in this way. So now what assumption we are going to take, we can, I mean, there can be multiple argument. You can figure out what is the average of last 3 years dividend and put it the number here and assume that is going to be the same dividend. But I'm not going to do it. I will be more generous as a Microsoft dividend. If I get more dividends, I'll be happy. So I'm at least thinking they will pay 30 percentage of their payout ratio as a dividend for the next 3 years. Even though it is bit higher compared to the last 3 years number, but I'm hopeful that we would get that number. Then stock repurchase for the last 2 years it's 20 percentage, and then in the previous year it's 37. I would average it here, or even you could think if any number might be the most logical or reasonable one, that could also be fine. I would think that can be the case for 2 years, but I think over the period of time as the company gets more mature, they will repurchase more stocks. So that I will assume 27.5 percentage for the last 3 years. Or if you think there is any other better number based upon your insights, please feel free to update, but make sure you are following that consistently. So now we could do dividends paid. So now we know what is going to be the dividend payout ratio, and we know what is the net income. Multiply it and get what is the dividends paid. We'll put a negative and multiply it with the net income and forecast it. Similarly, we know what is the stock repurchase. This number, multiply it with net income. Done. Next item, commercial paper. As I mentioned, we need a debt schedule. Even the next item is change in current portion of long-term debt. That will also we will get while we build the debt schedule. So now rest of all the items is done. We will do summation of these all numbers and get what is the total cash used in investing activity as of now. Then next one is purchase of property, plant and equipment or capex. For this we would see last 3 years numbers first. That is this one, additions to property, plant and equipment. In 2023 it is 28107 minus 28107 minus 44477 minus 64551. So now similar to how we did the dividends payout and share repurchase, we can compare it with net income, or there might be other possible as well, like you can compare the capex to the total revenue or any other metrics, but I feel there should be some slab on how I am comparing. So to make it consistent, I'm going to use it with net income. So what I'm going to do is capex by net income, and I would see how much historically we spent. So this number I want it in the percentage. So in 2023, they spent 38% of net income in capex. Next year it is 50%, and in the most recent year it's 63%. Since what I'm thinking is a lot of companies are spending a lot in AI this year, and I'm thinking most likely for the next 2 years at least the number will be higher. So I would put 70% of net income for the next 2 years they will spend as capex, then gradually it will reduce. Or if you have any inside information about the company, or if it's a small scale company, if you know management, you could forecast the number. But since I don't have any inside information, I'm just going to take an assumption and go it away. So negative of this number multiplied with net income, and I will forecast this. Change in non-current asset. Non-current asset we have here, I could just do the difference between these two numbers, but there's a small delicate part to it which I will work when I start calculating what is the property, plant and equipment value. So for now, I'm not going to update anything. I will just keep a hold of this one and come back later. Non-current liability, we know what is the last 2 years number. We could just take a difference of it. This is a straightforward thing. And I will do these items and work on. Then finally, the cash flow from financing is summation of these two numbers. Then cash generated by end of year is nothing but this one plus cash flow from investing plus, I think I did something wrong, plus cash flow from financing. So this is the cash which as of now we are seeing the Microsoft will generate by end of every year. But still note, we haven't calculated depreciation, amortization, nothing in debt, which we will develop a debt schedule. So I think now we have say pretty much 50% of the cash flow statement, and I will stop this video here. In the next part of the video we'll come back and tie all the loose ends here and ensure and validate if our model is balancing. So in this fourth part of the video, we would cover how can we get the numbers for these missing pieces in the balance sheet and cash flow. Once we get that information, hopefully our model should balance. So with that, let's get started. To start developing the individual schedules for each and every line item or each and every missing piece here. So I would start this with depreciation and amortization because the cash flow statement is the first item which we are missing. Even though for the last 3 years we knew what is the total depreciation and amortization, we couldn't consider this as or we couldn't grow this with revenue or any other metrics simply. The reason is it contains two parts. One is depreciation, which is for property, plant, equipment, and amortization. Since Microsoft hasn't provided any explicit information about the amortization, I'm going to assume the safe assumption that all the amortization is coming from long-term asset or non-current asset. So for this, what Microsoft have provided is how much depreciation came from property, plant and equipment alone. That we will go back to our cash 10K report and I'll show you the footnote which I'm referring to. This one. Okay, this is the information I'm looking for. If you see, this is a property and equipment footnotes. Here they have mentioned how much depreciation have occurred on year and total accumulated depreciation. What I am more interested is this statement or this line where they have mentioned during the fiscal year 2025, 2024, 2023, depreciation expense was $22 billion, $15.2 billion, $11 billion respectively. Since this is a property and equipment, this depreciation is only for the property and equipment. And if you go back and take a look at our total depreciation, it was $34 billion in 2025. out of which only $22 billion is on property and equipment, and rest of the number, which is 35, whatever we have it here, 34.153 subtracted with $22 billion, is going to be on the non-current asset. So with this assumption, let's first start working on the depreciation and amortization schedule, and we will work on this one. So what I would do is depreciation related to property and equipment. We will input the numbers here first. $11 billion in 2023, 15,200, 22,000. Okay. So this is a depreciation of the property, plant and equipment. Now we need to first figure out how much depreciation could have occurred for the next 5 years. For this, what I would do is a simple thing is calculate how much of depreciation happened to the capital expenditure or even to a total property, plant and equipment. Then use that number and forecast it for the next 5 years. So I will tell you what I'm doing. Property, plant, equipment value, I'll update it here. Property, plant and equipment. I think it doesn't make sense to do it with property, plant, equipment. Rather, what I would do is I will figure out how much depreciation happened with respect to capex. We knew what is the capex for the last 3 years, which is this number, and we calculated what is the numbers for the next 5 years as well. Now I will calculate this ratio and try to assume that is going to be the number or the ratio for the next 5 years as well. So let's do it. Depreciation related to PP&E by capex. We have got these numbers, and I'm going to assume this is going to be the average for the next 5 years as well. Even though it might not be very accurate because we don't have much information about this, I'm going to take this assumption and I will stick to this throughout this video. So what I would do, this number, and so now we got the depreciation related to the property and equipment. Now we need to figure out what is the depreciation related to non-property equipment, which is long-term asset. I'm going to take that assumption. Since we don't have much information, I'm going to take an assumption. Whatever depreciation is not covered in this property and equipment is fully by the long-term assets. So first I will calculate long-term assets. Long-term asset is this number. Even though for 2023 we don't have it, that's absolutely fine. I will remove this. Then amortize D&A related to long-term assets, which is nothing but difference between the total depreciation amortization and depreciation related to PP. So we will do that. This one minus, so we got this. So now what we are saying is in the year 2024, depreciation on the long-term asset is $7 billion. In the next year it is $12.1 billion. We will take this ratio and assume that is going to be the average for the next 5 years. So by total asset. So with this, I will calculate what is the D&D related to long-term assets, which is this number multiplied with this number. Now we can calculate total D&A, which is nothing but D&A not related to this plus D&A related to this. That's it. So now we got the first missing piece in the cash flow statement. Might be I will just put this as well so we know what we are doing here. This is D&A schedule. Perfect. So now what we can do is just tie this number to the depreciation amortization here. This number is here and then tie it up. So first piece is done. The next one we could go to the repayment of it. But more logical way I will do is, since we calculated what is the depreciation amortization, by end of the day depreciation amortization will also have the PP in it. That is where purchase of property, PPS and property, plant and equipment. So first, if you remember, in the balance sheet we have PP, haven't updated it. Let's do this purchase of property, plant and equipment schedule and then go back to the next item. I think this will be the more reasonable way to do it. How I am going to do the property, plant, equipment? It is simple. I will use the same way. This is PPE CHEDULE. What I need is first beginning of period of property, plant, equipment plus capex, because property, plant, equipment we are going to purchase some, going to invest some amount in the PPE, so that is nothing but capex. I'm going to add it less the D&A related to PPE, which is nothing but this item. Then we would get the end of period amount. So by doing this, we can calculate what will be the property, plant and equipment value for for the next 5 years. We know what is the end of period value from our balance sheet. I will go and link that number. One simple logic is 2024 end of the year PPE is equal to 2025 start of year or beginning of period PPE. So I'm in that way I'm going to link these two numbers, that is, because this is just a day, right? Say assume the 2024 is ending at 6/30/2024 and the year 2025 will begin at July 1, 2025. So this number is just going to be same as this number. That's the simple assumption I'm going to take. With this, I'm going to assume this number is going to be the same. Now we have already calculated what is a capex. So capex is nothing but this number, purchase of property, plant, equipment / capex. But note, in the cash flow statement it is a negative because cash is going out of company. Indeed, that's how it should be. But while we do the PP schedule, it should be positive because we are adding that to the property, plant, equipment. So I'm going to add one negative and get that number. And done. Next one, depreciation and amortization related to property, plant, equipment. We have just calculated it here. Note here it is positive. Indeed, that's how it should be because we are going to add it in the cash flow statement. But here it's going to be a depreciation, which is it is going to reduce the value. So we need to include a negative before this one and update this. Now, if we do summation of all these three, we will get what is the end of period amount. Summation of these three guys and just forecast it for the next 5 years. With this, we got the second missing piece, which is the property, plant, equipment. We will go back and link it here. So property, plant, equipment is this value. Perfect. Now we need cash and cash equivalents, debt. Okay, I think pretty much we are done. And okay, let's do one more thing before we go to the debt. I think the most crucial part, we will do change in non-current assets. So if you remember, while we did the depreciation and amortization, we consider all the D&A not related to PPE's long-term asset. So we need to figure out Similarly, how we did for the PP schedule, what is the change in long-term asset? Even though we have the long-term asset value here, we couldn't directly take a difference between these two and put it in the cash flow statement because there is a depreciation already counted here. That is, in here we already counted the depreciation. So if we just do the difference of those two items, we will be double counting the D&A again here. So to make it very clear, we are not going to double count, just only once we are going to do it. We will develop a separate schedule for non-current asset as well. So copy this, non-current asset schedule. Same thing, beginning of period plus or selling the non-current assets less D&A of non-current assets, and then end of period. We already know what is the end of period non-current asset from here, which is this number. We already calculated for all the 5 years. We'll just put it. Then the same analogy, last year end of period is equal to next year beginning of period. So do this and update this here. Next one, we also know what is, we don't know what is the change, which is what we are going to calculate, but we already know what is the D&A of non-current asset, that is here, and it should be in negative. D&A of this number. So now, since we have all these three, a simple understanding is if we do the sum of these three items, we should get this item. So we are just going to solve for x, or basic algebraic equation. This one minus this one plus, or no, I think plus this one. So if we do this, we should get this number. No, I think I missed something. The summation is not working. Okay, I think I need to do negative here because we are going to subtract it. So if I do this, we should get the same number which you are saying, 47055. So now if I do this, this is done. So with this, we can update the number here in the change in non-current asset. Please make sure here the value is positive, which means we are going to invest some money to purchase a non-current asset. But while it goes to the cash flow statement, the cash is going out of the company, which should be in a negative sign. I think the most crucial part is ensuring we are putting the cash flows right, either it's positive or negative. I think that is where a lot of issues will happen, but I hope whatever I did it right and it doesn't throw up an error. Now let's come back and revisit the important part of long-term, debt part or debt schedule. So here what we need is two parts, or how much the company have repaid, how much new debt the company is taking, and the commercial paper and change in long-term debt. So we will do this. I'll first go to the 10K and I'll show you one quick schedule here, which I think I already shown. Whatever company you are evaluating, at least most of the US companies, they will have a debt schedule given. If you read it through, the following table outlines maturity of our long-term debt, including the current portion as of June 30, 2025. Here they have given in 2026 they need to repay $3 billion. In 2027 they need to repay $9.2 billion. In 2029 they need to repay another $2 billion, and thereafter they need to pay $34 billion, which is nothing but this is the repayment amount I am looking at, which is going to be updated here. For this, I can just copy paste this numbers or just type in this number as negative thing. But since I also need to go back and figure out what is the long-term debt and what is the short-term debt, I'm going to develop a schedule for this, how we did for previous two instances. So I will call this as debt schedule. So to be precise, this is long-term beginning of period plus new debt taken less the repayment and end of period. So we know what is the end of period debt from this number. We'll put in here. Then we know this number is the same as here, going to extend it. Then we will get summation of these three guys. That's it. So now in this schedule, Microsoft have mentioned they need to pay $3 billion in the year 2026 as a debt repayment. That is nothing but this number. $3,000 they are going to pay. In the next year, they are going to pay $9.25 billion. 9250. Next year, they don't have any schedule as of now. In the next year, it is 2054. Next year, 0. Now, new debt taken. You could, simple assumption we can take is there is Microsoft is not going to take any new debt. Already they have a lot of cash sitting on their bank, but it's not going to be the case. As of now, Fed have reduced some interest rate by 25 basis point, and I foresee that to happen in the future as well. So I am predicting 100% Microsoft will take more debt because it's getting at a cheaper rate. I would assume in the next 2 years they could take say $5 billion of debt, and then might be from the year 2028 they could take say around $4 billion of debt, or might be you could even consider the Microsoft is not going to take any debt. That's absolutely fine, but you need to take some very good educated guess out of it. But since for the last 2 years their total debt is around $40 billion, I'm also making that same number. Might be even I could assume in 2030 they won't be taking any long term debt as well. So this is what I'm thinking, but we will wait and see how the long term debt numbers pans out to be. So now we got what is the end of period long term debt. We will first link it here, that is this number, and this is done. Then we can link what is the repayment they are going to do. So repayment of debt, here it is going to be positive, but sorry, here it's already negative, so we'll just link it there. Which is done. Then new debt taken, which also we have captured here. This is going to be this number, and then I'm going to link this here. Perfect. So we have captured these three items. Now we have two more items open here, which is commercial paper change in current portion of long term debt, which is nothing but difference between these two guys. If you keenly note, while we did the long term debt, there is one word which Microsoft specifically mentioned. The following table outlines maturity for long term debt, including the current portion as of June 2025, which means there won't be any number here as a current portion of long term debt for the next 5 years, because everything is included in that debt schedule which we recently developed. So I'm going to make this number as 0 because that information we got clarity from the 10K report. Now I'm just going to do the difference of these two numbers and put in here. That will get the change in the current portion of long term debt, that is this row. Okay. Good. Next one is commercial paper. Commercial paper is nothing but the short term debt which the company takes, which is like less than 180 days maturity. Even I could make it complex, build a commercial paper that is the company is taking a very short term debt. But I don't think Microsoft doesn't have that necessity to do it, because already as of 2025 they are sitting with $30 billion cash. But yes, they can take commercial paper, but I don't want to make this video more complicated. Might be in some other video, if there is any ask, we could do it. For now, I'll just say there is no commercial paper, or Microsoft is not going to take any new debt out of it. Then I will just link it here, which is just a difference between these two. Even though by end of it it's going to be 0, I will put it there. Let us see. Okay, I think pretty much we have done all the cash flow statement, and we got how much cash the company has generated for each and every year. Now let's see what is empty here in the balance sheet. Cash and cash equivalent. This is nothing but the total cash the company has, which is summation of the previous year end of previous year cash they have plus the new cash they have generated this year. That is nothing but the last line item in the cash flow statement. So let's simply add this and get this number filled. This plus this number, and I'm going to do the same. By doing so, we could see, or we are forecasting that Microsoft would have $200 billion just as a cash sitting in them in the year 2030. $200 billion is like way too much, which I don't think realistically it's going to be possible. They could return much more cash back to the shareholders. So for this, what I would do is I'll come back and update how much they are going to pay in the dividend. If you recollect, we have mentioned the dividend payout ratio is going to be 30% for the next 5 years, and share repurchase is going to be around 25%. I'm going to slightly increase it because I am not sure what they are going to do. I mean, as per our number, 200 billion is too high. Either they need to reinvest in capex or they would return it back. I don't think it adds much value to have with that cash. So I'm going to increase this number to 50%. That is, they are going to pay 50% of dividend in the next 5 years. Then stock repurchase can be at a 35%. If I do so, I see the number is going negative, which I don't think Microsoft would do. So I would slightly then, I mean, I made from 30 to 50, I will go to 40% now. Then I will stick this to 30%. Again, this I'm just playing with the number, but you could think what can be the most reasonable one and update it. Might be I will make this, 35, 35, 35. Okay, so now let's see. I think by end of now in 2030, it's $61 billion. Even though it's high, slightly high, I feel this is more reasonable one. They will get back, I mean, they will give back a lot of cash to the shareholders. So this is done. Now we have these two items. I think if we complete this, our model is done. But before this, I just realized one thing. We have this two line item, which is interest and dividend income, interest expense. We need to capture what is going to be this number. So for this, first let's go back to the 10K and figure out whether they have mentioned anything about interest rate. I'll just type in this word. Okay, so what they have mentioned is the short-term debt. As of June 30, 2025, we have no commercial paper issued outstanding. As of June 30, 2024, they had 6.7 billion of commercial paper with a weighted average interest of 5.4%, and the maturity is from 28 to 150 days. So what they have mentioned is the commercial paper or short-term debt which they had in last year is around at a 5.4% interest rate. Then for long-term debt, they have provided this by year on year. I think our model will get more complicated if we do this way. So what I would do is I will take the maximum interest here, which is around say 5% to 5.49%, and assume whatever debt they have, they will be paying 5.5% of interest. I know it will be on higher end, but that's absolutely fine because Microsoft by end of it is a huge company, and the small change in interest rate won't be affecting them. So I will do this one. First, Okay, first I will get what is the long-term debt. I think we don't have short-term debt. Let's confirm that. Yeah, we are not going to have any short-term debt, only long-term. So I will first put that number here. Sorry, I think I'm looking at the wrong place. Here is the long-term debt. Then, as I mentioned, the interest rate I'm going to take it as 5%. Might be, if needed, you could do more, dwell deeper, and figure out for 2020 each and every year what can be the interest rate. But I think I should be fine with this assumption. I'm not going to make myself complicated here. I'm just going to make it percentage. Then I would say interest expense, which is just multiplying these two numbers. Similarly, we need to calculate what is the interest income. For that, we need to know what is the cash and cash equivalence, which is from our balance sheet. Now let's put in interest income. Maybe here I read through the report where they haven't mentioned what is explicitly the interest rate they got in recent year. But I'm going to take in simple assumption that they are going to get 3.5 percentage as an interest for the next 5 years. Might be you could argue Fed is cutting the rates, the number might get lower. It's absolutely fine. You could make that interest income will be only like 3%, but in that case you also need to come and update the expense here, because if the interest rates are getting down, even the rate which they are going to get the debt is also getting down. So make sure you are consistent in the way you are going to calculate it. I will put this is not income, this is interest rate. And then this is the rate. So now this number multiply with this number, we will get a value. Okay, pretty much we got these two. We will go back and link it. This is 184. Interest income is H184. I'll link this. Then interest expense, it should be negative. Please make sure you are putting that numbers right. So we also tied up this part. Okay. The final two items we need is retained earnings and common stock paid in capital. Let's revisit our balance sheet first. Here, if you scroll down, there will be one page as shareholder equity. Here you could see common stock and additional paid in capital. How it is calculated is beginning of period, we know. Common stock issued, we haven't calculated it or we haven't considered it, so I'm not going to include in our numbers. Share repurchase, we already considered it in our cash flow statement, so I don't want to double count it. I'll leave it. Then stock based compensation. So by doing this summation, we will get what is the common stock paid in capital by end of the year for next 5 years. Similarly, the retained earnings is beginning of period plus net income plus cash dividend plus stock repurchase. We will get this number. So by doing so, we will get the rest of two items. Let's work it upon now. So what I will do, retained earnings. Retained earnings is beginning of period plus net income less dividends less repurchase end of period. So the retained earnings is this number, and then beginning of period of value is this number. Then this is going to be nothing but summation of all these guys. So now we already know what is the net income, dividends and repurchase. It is just going to be linking the number. So it's going to be real quick, nothing much. Repurchase is The cash flow statement, where is the repurchase? Repurchase is this number, we'll put in here. Then we also know what is the dividends in the cash flow statement. Let's go back, and dividends paid is this number. Let's update it. Then finally net income from the income statement is this number. So then now this is the end of period retained earnings. We'll just link this number. Retained earnings equal to this one and link it. Finally, common stock and additional paid in capital. That is, I will copy this, put here. Common stock APIC. This is beginning of period, share based compensation, end of period. Beginning of period is this guy. And then this is this guy. Then this is going to be sum of these two numbers. Then share based compensation, we will have it from here. So now if we link this number, hopefully model should balance. If we did everything right here, whatever number you are seeing here, which is not balancing or balance check is missing, this is the number we should also see by end of period. So now I could see the model is perfectly fine. I will just link this number. Perfect. So now you could see the model is fully balanced. So we completed our Microsoft three-statement financial model, which is fully integrated. If you make one change anywhere here, everything will be reflecting accordingly. So this concludes this part of video. In the next part of video, I will take one extra mile to go and figure out the sensitivity analysis. What it means is, here we have mentioned our revenue growth will be 16%, 15%, 15.5%. But what if you think I want to sensitize this? That is, hey, you know what, 16% is too high, it might be only 14%. Or the other argument could be 16% is less, it can be even higher. So in that scenario, we could sensitize this and figure out how our numbers are changing. That we would do in the next part of video. So first, let me rename this tab as financial statement model, and I will create a new tab and then sensitivity analysis. So first, you need to figure out on what are all the input parameters you would like to do the sensitivity. For now, what I'm going to do is revenue growth, because by end of the day, the major driving force of all this model is the revenue growth. I definitely need to do the sensitivity, because I feel 16%, even though Microsoft can achieve this, I feel it's a bit on the higher end. I will definitely take this, and I would do product COGS by product revenue. Sorry, I don't think I will do this. I would do this one, service and other COGS by service revenue, because these days Microsoft is spending a lot in service sector, and what if they are not going to achieve the expected returns? In that case, I'm going to increase this number slightly and figure out how the numbers would look like. Then next one is I would do it on R&D, because even the most recent news is a lot of investors are concerned that a lot of organizations are making huge bets on research and development on AI, but not sure about the return. So I definitely need to do on the R&D. And then I would take tax rate, because by end of the day, tax rate, as I just discussed in the beginning of start of this recording, I would also plug in some numbers on tax rate. On top of it, even you can come and take any other number, like you could, we have updated how much dividends the company will pay. Like we have considered the payout ratio as 40%. What if you think that, you know what, Microsoft is not even going to pay dividend for next 5 years? You could just make this number 0 and evaluate. Then stock repurchase also, we assume whatever net income is, 30% of the net income Microsoft is going to repurchase a stock. Again, you can argue that they won't do any repurchase. Even you could do that number. The beauty is, since everything is integrated, if you just do a sensitivity analysis and integrate it, everything will reflect. But now I'm not going to do anything on payout ratio, stock repurchase. As I discussed, I'm going to do the 4 different items here in the income statement, which will even in turn reflect in all the other parts of the video. I mean, all other parts of the statement model. So let's get started. I will just copy paste these guys. What I'm going to do, the sensitivity, revenue growth is the first one, service and others, and this is the second one which I would do. Then next one I will do is tax rate. So these are all the 4 items I'm going to do the sensitivity analysis. So let's beautify this a little. Copy this and then we'll just paste it. No. So just copy and paste here. Okay. So these are the 4 items I'm going to do. I'll just change this sensitivity analysis. Hope I got the spelling right. Perfect. So now, as I mentioned, I need to figure out. I mean, I'm going to say that. Well, okay. First, before that, I'll just copy paste what are the numbers we have as of now. From here, I can do all the topics. Revenue growth is this number. Then service and others is this number. Then R&D as part of total revenue is this number. Then finally our tax rate is this number. This should be in percentage. Maybe I will do this quickly. So these are all the numbers we took as an assumption for all our modeling. So now what if I wanted to say revenue growth 16% for next year is too high? It can be only 12%. Then for next 2 years it can be 12%, then 15% might be reasonable. So in this case I need to do or I can plug in different number and figure out how the model is going to do. So now what I'm going to do is, for all these 4 line items, I'm going to plug 2 more cases, that is best case and weak case. So I'll show you how I'll do. That is best case, street case, best case, street case and weak case. So I'm just going to indent this. Maybe I'll tell you will get to know why I'm doing this here now. Copy this, copy this. Perfect. So if it is revenue growth, we already know what is the numbers which we gave, which is nothing but the street case number. I'll just put in here. Now what we can do is, I'll just remove all these guys and offset. No, I will keep that number here and then we'll just do offset here, not here in this column. So what I can do is, either you could come back and say, you know what, we are going to assume Microsoft revenue is going to be just, might be, first we'll do the weak case, 12%, 12%, 12% for the next 5 years. Or you could do an offset function. Offset function is nothing but, hey, you know what, whatever revenue I'm saying it's too high, I will reduce it by 2% to get my weak case, and to get the best case I will increase it by 2%. This even you can do. So the long story short is, the simpler thing is to do an offset to your best understanding. What percentage can it be, you can update it and input the numbers. Or if you have more insights about the business, you could even type in for a year over year how much it is going to do. But for just this video's purpose, I'm going to take an offset and do the rest of items. I think right now, even I think 14%, even though it's achievable, I want to be conservative, so I'll just do 2.5%. Then for the best case, I'll just take 1%, even 16% is a huge number. But if I do 2% offset, which will be 18%, that's too high. Well, to be honest, I'll be happy if Microsoft achieve it because I hold a good amount of Microsoft shares, but I want to be considerate in what I'm doing, so I'm just keeping this as a number. Then similarly for the service, this is the number, and here the best case is the COGS is lesser. So which means we need to reduce some percentage from here to get the best case, and to get the weak case, we will add it. So what I'm thinking, right now we are saying 35% as the COGS. I think minimum it can go is 32.5% at least for the 2-3 years. Maximum, if whatever investment they made on AI is not helping us, it will be like higher, it's on the higher end. So I'm just going to take this assumption. And then see how the number is going to look like. Similarly for the research and development. So the research and development, the best cases, the company is not spending a lot of money on R&D, which will increase our net income. But by end of the day, the company need to spend a lot of money on R&D so that they will get better products out of it. So I'm assuming negative 2.5% is offset for the, sorry, best cases, I would say negative 2.5%, where they are not spending money. Weak cases, positive 2.5%. So in this case, this number plus this number, and then this number plus this number. This is done. Then finally tax. So tax rate, we know for the street case, this is the number. And for the weak case, I'm going to make it close to 21%. That is our statutory tax rate in the US. But again, you could argue like 40% of Microsoft revenue is only coming. I think 50% of revenue is Microsoft is from US, rest is from rest of the world. You could figure out or argue that it can be even beyond 21%, but absolutely fine. You could feel free to update the number, but I will make something close to 21%. I think this number looks fair enough for me. Similarly, in the best case, I will just go by negative 1%. I really don't know if I take the same 2%, it will go to 16%. That might be lesser. So just this one and do this. So we now did all the inputs. Now what we can do is, I will do this one as well. Cases and active case. So in the cases, it can be, we will go to data. Here I'll go to the list, and then source is these 3 items, and then so here we have now the 3 cases: best case, street case, and weak case. Now how the number should look like is, right now if it is street case, this is how the number should look like. Whatever number we have here, these are the numbers we needed. But if we switch from, say, street case, from the street case to best case, we wanted these numbers to be replaced by the first row of each and every segment. This is what we need. So this is where I would write a very simple Excel function to get the number what I need. I'm just going to remove this for now and start doing offset function. Might be offset function, you guys could have used it. Just give a reference from which reference you need to do, and then rows. Count how much rows you need to go down, and then similarly columns if you need to go columns, but for this exercise I don't need to go to columns. So we'll do that. I'll take reference as this column and my row. Here, to make it even more simple, I'll just use another match function to get the row. I need my Excel function to go and look up this value in these 3 items here. Then do an exact match. then do a exact match which is 0. Then columns I don't need to move now and close it. So to simple words, offsetting and H7, this is a reference and I am going to match. If this is best case, come to these 3 lookup rows, figure out what is the row, in this case this one, and input the number here. If I switch from best case to street case, the numbers will change accordingly. So for this, I will make this as a constant because, or anchor it, because this won't change throughout the rows. Now might be everything I will do it with the street case so that it will be simple. And then I will pull this forward. Let's evaluate just for one case if it is working. So for the street case, we are seeing the same number here, 16%, 15%, 15.5, 12.5. We will change from street to weak case. If we change to weak case, you could see the numbers changed. It is now 13.5%, 12.5%, 13, 10 and 10. This is what the number we have. Similarly, if we go to the best case, you could see the numbers cease change. Now we need to do the similar thing for the next row as well. You could technically drag and drop this, but it wouldn't work because we need to add one more match function here. So for this, what I'll do is I'll just first copy this guy and put it here. Then again, the first function is not going to change. I'm going to match this one, which is whatever case it is, with any of these rows and get the value. But additionally, what I need to do here is I also need to say if it is service and others, the function should know it should come here and figure out what is the best case here, street case and weak case here. If I'm going to R&D, then it should come to these 3 rows. So accordingly, I'm going to add one more match function for the application to figure out where this row is in this set of array. Then I would use an exact match, and since we are using the reference here, I'm going to add a -1. Let's do one more thing here to be very clear. I want to anchor these guys because if I just pull this for the next row, it might spill over. Now let's evaluate if our number makes sense. Let's go back to street case. Okay, in the street case, the number for this service and other COGS is 35, 35, 36, 35, 34. And here, yeah, 35, 35, 36, 34. If we switch from our street case to best case, it's 32, 32.5, 33.5. That is the same number we are having in this row. So which means whatever we did here makes sense. Now let's move to the third segment. Here I will just copy this formula and just change the offset function, simple. So here rather than calling D10, which is service and other, I will call D11, which is the total revenue. I will just then pull this forward. Similarly, here rather than calling that, I will call the tax rate. Just pull it here. That's it. So now I hope if I did everything right, the numbers should look like, if I move from best case, yeah, the tax rate is 17.28%. That's the number we are seeing here. Then if I move from best case to weak case, I'm seeing 20%, 20.78 as a tax. That is what I'm seeing. So right now we have built this sensitivity. So by just switching these items, we could see how our numbers change. But we did the major part. We just need to link these numbers back to our financial statement model. So even though we did it, even if we switch anything, you could see nothing changes in the financial statement model, because we haven't linked the numbers which we got here, that is sensitized number we got here, into our financial statement model. So now what I'll do is, I will remove the numbers which we typed in here, then just go and link the number which we got from this scenario. Right now, you could see revenue growth, it says 13.5, 12.5. That is the number you are seeing here. If I switch from weak case to street case, you could see the number change to 16% here, and the same number you could see here. So that is why building an integrated model is needed. If we do a change in one place, it will reflect in everywhere, and accordingly our rest of the balance sheet and cash flow statement will also get updated. So I'll quickly link the same way for others as well. I will service under this service. This one I will remove this guy and then link this guy. Done. Then R&D, I will delete these numbers and link that from here. This is done. Then similarly, the tax rate I will delete and then link it to this. Perfect. So now you could see the numbers change. Maybe to even make it more simple, I will just give the, see here, cases is come to data validation, list, sources, these three numbers for these three guys, and hit OK. So even here now it will be like street case and others, and here I'm going to link that to here, because if you remember, for all our offset and match function, we are using this as a standard, this as a lookup value. So rather than it says E3, I'm going to link that number from here. Then this number is not needed. Okay, so I'll just do this in a different color so we know while I come back to this model, this is something. Okay, so now you could see street case, the net income says $114 billion in 2026, and if I switch from street case to best case, you could see the number change from 114 to 128 billion. And similarly, from best to weak, if I switch it, you could see the number drop or updated accordingly. The beautiful part about this here is, say in the street case, you could see what is the total cash generated by end of the year. That is this number, $6.6 billion. If we even change this number from street to say best case, the number which was $6 billion now reduced to say $3.46 billion, which means we did the proper integration, and most of the numbers in the cash flow statement we took some reference from the income statement. Accordingly, the numbers being changed. So this is what I wanted to achieve, and why I want to do is as part of the next video I will do the discounted cash flow analysis. By end of the day, if I just have one numbers, that is as a street case, I will get only one value as a DCF, and I wanted to plug in different numbers, which is how the numbers will look like if the revenue growth is higher, how will the numbers look like if the revenue growth is lesser. That is why I have developed the sensitivity analysis in this video, and in the next part of video we will plug in best case and weak case and compare how the numbers looks like and evaluate if it is in a good stock is in a good good buy range. So that's it for this video. If you like or if you learned something from this video, please consider liking this video. If you have any questions or thoughts or comments, please feel free to put in the comment section. And if you would like to see more of this kind of video where we're doing the financial statement modeling and doing the DCF valuation or trading firm valuation, or even I would do some more videos like doing the financial analysis or fundamental analysis and reading the quarterly or 10K report. To watch those kind of videos, please consider subscribing to my channel as well. With that, we'll wrap up the video. Thank you and take care.